So right now I'm going to teach you all about morning panics, my single favorite pattern. Study up! What's up? Tim Sykes, millionaire mentor and trader, here answering your questions. My number one most favorite pattern right now, dip buying morning panics. I have 670 videos. Click the link just below. I'm going to link to those videos. They're on Profitly. Study them, okay? This is not an exact science. The more history that you have knowledge of, the better prepared you are for future morning panics. That said, there are some key indicators that you can look for. I don't want to just dip buy any stock, okay? A lot of people say, oh, this is a dip buy, this is a dip buy, and I'm like, what the fuck, what kind of drug are you on? Like, you're not even paying attention. You obviously haven't watched my video lessons. You're just dip buying anything that's crashing. That's a very dangerous pastime. If you buy some of these stocks that frankly deserve to go down, they're not going to bounce. They're just going to keep going down, and you're going to be like, yo, stock trading sucks. Stock trading sucks if you ignore the rules. Dip buying sucks if you ignore the indicators. So, indicator number one, I really just want to dip buy plays that are up over several days, over several weeks. Not a play that has been spiking for 1 or 2 days. The more time that it's up, that builds a bigger panic, because sometimes people use stop losses to protect themselves along the way up, and as the stock crashes, it's like Inception, a dream within a dream, but you have stop losses after stop losses after stop losses. It creates a tsunami of sellers, not necessarily natural sellers. It's just because all these key levels are being triggered at the same time, and there's 500, 700, 900 sell orders trying to get executed. None of them are getting executed, so it creates a panic. That is the inefficiency that we're trying to take advantage of. Those stop losses, all the people panicking, even when there's no bad news. And a lot of stop losses get taken out if the stock has been running for several days or several weeks. If the stock has only been spiking a day or two, there's not going to be that many stop losses, okay? The key is, and you don't know where the stop losses are, no one tells you, you can only guesstimate, right? You need a lot of people who are trying to protect themselves along the run up. So if the stock has been running up for, let's say, 20 days, there's a lot of stop losses built in. Let's say 20 days with no big drops. All those stop losses can get triggered 1, 2, 3, 4, 5, and it'll crash the stock. So if a stock, let's say in 20 days has gone from 1 to 7, and in one morning when it starts dropping from 7 to 6 to 5, you can get extra stop losses that take out 4 and maybe even 3. And now it's a 50% drop in like maybe a half hour, not because the stock has done anything bad, not because the company has anything bad, but because all of those stop losses created that 50% off sale. If you think about Black Friday or going to a store and getting a sweater that's 50% off, that's fantastic. That's a good deal. But a stock that's down 50% might be a very different company than when it was up. If it's down 50% because, let's say, the FBI just busted down their door, it deserves to be down 50%. It might even deserve to be down 70 or 90%. That is not a dip buy. But if it's down 50% only because of stop losses being triggered and there's no negative news, that should lead to a nice bounce. Why do these stocks bounce? Well, just as the stock has been going up, let's say every day for 20 days, a lot of people missed out on the run up. So they're waiting for that big dip. And then they're like, oh, this is the time I can finally buy it on the dip. And I don't feel that bad missing out on the initial run up. So that's one group of people who are buying. A second group of people who are buying on the dip, guess what? Short sellers. If they were betting against it on the way up and it finally comes down, they can buy to cover their shorts, which means that they're basically buying. So you have two groups of buyers into any big morning panic. How do you know where the bottom is? Well, you have to look at previous support. Look at where the stock before it was breaking out. Look at, how did it act before the big run up? Was there key support at, let's say, $4 a share from 21 days ago or 25 days ago? Before the biggest spikes, where was it kind of like chilling around? That should theoretically be a bottom. Also, you have to look at level 2. Look at the bid stacking. I have a whole DVD called Learn Level 2. It's 6 hours. I think you should read it. I have a lot of live trading video lessons where you can see the bid and the ask. It's like a seesaw. And when the stocks are panicking, there's like 10, maybe even 50 15 market makers trying to sell on the ask, and the bid has 1 or 2, and it keeps getting taken out. But eventually the seesaw can change momentum, and it's called bid stacking. So there's different market makers who are now solidifying on the bid, and that can be a sign that everything changes. And sometimes these bounces can be very quick, so that's why you have to be prepared ahead of time. Click the link just below this video, watch the 600 plus video lessons on morning dip buys, learn and see what I do right, learn and see what I do wrong, and leave a comment underneath this video too. Let me know if you like this video. Hey, Tim Sykes, millionaire mentor and trader. Thank you for watching my videos. I hope that they help you. I want to share everything that I've learned over the years. You can check out more videos right over there, and also click subscribe so that you can watch all of these videos, get that knowledge, and become my next millionaire student.